Hey everyone, welcome to Lumovest. We learned previously what a dividend is, and now we're going to learn how to analyze dividends using a metric known as dividend yield. If you haven't yet, subscribe to our YouTube channel so you get all our videos helping you become a sophisticated investor. In simple terms, dividend yield is a measure of the return on investment we're getting solely from dividends. It's calculated as dividend per share divided by price per share. While the dividend per share tells us how much dollar amount each stock entitles us to, dividend yield puts the dividend amount in perspective with the stock price. Why do we need to look at this metric? Because it's misleading and out of context to just look at the dividend per share you get without considering the price you have to pay for the stock in the first place. Say we have two stocks. One stock entitles us to $1 of dividend a year, but the other stock entitles us to $5 of dividends a year. Without considering the dividend yield, investors may be tempted to conclude that the stock paying $5 of dividends per share is the better deal. But say the first stock is priced at $10 per share, while the second stock is priced at $500 per share. This means we could either pay $10 to buy the stock that entitles us to $1 of dividend a year, or $500 to buy the stock that entitles us to $5 of dividend a year. Dividend yield puts in perspective how much dividends we get in return for the stock price we pay, what we're getting in return for what we're paying. So based on this information, the dividend yield for the first stock is 1 divided by 10, which is 0.1. We typically present dividend yields in percentage format, so in this case, it's 10%. The dividend yield for the second stock is 5 divided by 500, which is 0.01, or 1%. How we would interpret this number is that we're making our money grow by 10% from dividends with the first stock, and just by 1% of dividends with the second stock. If we make a big assumption that this is the only information we have about the two stocks, then it's better to buy the first stock because we're getting a much higher return on our investment. And that's just through dividends alone. Remember, there's also the return through stock price increases. We explain this concept in greater detail on our Lumovest website, so make sure to check it out. This brings us to our other point on dividend yield. Because dividend yield is a function of the dividend amount and the stock price, any changes to the dividend amount and the stock price would also change the yield. Stock prices change every day. Dividend per share doesn't change as frequently, but public companies do change it periodically as their earnings change. Consider Southwest Airlines, for example. It was only paying 0.0023 cents per share back in 1997. You have to own 5 shares to just get a penny of dividend. But the company has been very successful and grew its earnings significantly over the past 2 decades, and now it's paying dividends of 16 cents per share. So as the stock price and dividend per share change, so will the dividend yield. Now as a heads up, the dividend yield formula may seem simple, but there's actually a lot of intricacies around it. In our next video, we'll dive deeper into the dividend yield calculation and explain it in greater detail. Hope you guys found this helpful, and remember to subscribe. See you next time.